Welcome back everybody. Here we have another review and another case study of how we can use the concept of liquidity to trade the markets. Now if you don't know, liquidity is found beneath swing lows, like here, here, and here. Now the reason for that is people going long would have their stop losses at these swing lows, and it's just simply because of all the culminations of everybody's stop losses, and they're all put at these swing lows. Banks tend to push the market down into these areas to hit their stop losses, which will be loss for retail traders, and in return, banks will be profiting. Now the same thing is said for the highs and the equal highs. So we have a high here and these equal highs. There are also people going short as well, and the culmination of all these people shorting will have their they'll have their stop losses here at this swing high and these equal highs. So banks and market makers will want to take the market upwards into these stop losses. Now for us, it is our job or our idea to find which side of the market has the most liquidity. And if we're able to identify that, we should be comfortably able to trade in that direction and seeing the market go there as well. So right now we can see there's highs, swing highs, and there's swing lows. There's always going to be swing highs and swing lows, but which one is more relevant? Which side is more relevant? And I guess to answer that, we would kind of want to zoom out and look at a higher time frame. So that would be an hourly, 4-hour. Daily would be a little too much, right? Since we are day trading sessions, daily is nice to find the overall bias, but hourly is the highest you really need to go. You don't need to go any higher than hourly. Now right now we see that we're trading here, and what we really have on top is just this swing high, this equal high, this equal high, and this swing high for the buy side liquidity. But on the bottom we have a lot of these small kind of equal lows, swing lows, as well as this big equal low. This one is very far, or we can be unsure that it's going to go down that much, so we can kind of just ignore this for now and just look at these ones, the ones that are more relevant to us, because again, we're day trading and price may not move to this level within a day. So given that, since there are so much more swing lows than swing highs, we're going to be trading to the downside, and we're going to be aiming to short. Okay, now we're on a minute chart. Now we're probably trading on minute charts because we're day trading. So we could be looking at the charts and we can see that price has already kind of started heading down, but we have still not hit our targets. So we could still be comfortable shorting, right? We haven't missed the entire move yet. And so we could still be looking for shorts. We're going to be using 930 as our entry mechanism. And the reason why 930 is because that's when equity happens. And when equity comes, there will be liquidity injections into the market. So what we should see is some movement to the upside. What that does is it acts as a kind of quote unquote reset to take out all the people who are profitable shorting. So all the people who had positions like this would be stopped out, and then it'll permit us to keep going lower into the targets. So times like 930 is a good time for a quote unquote reset, where all the people short kind of get their positions out, and then we go lower. So what we can kind of use, right, is a short position as a limit order on where their stop losses are. So for example, this candle represents 914, and so we're going to be waiting 15 more minutes for equity. And here on a 5-minute chart we see a kind of gap, and a 15-minute chart we also see this gap with this order block right here. So back on a minute chart, and seeing these two from the higher time frames, we can kind of have our stop loss right here above the order block, and our limit order would be here on these swing highs. And the reason for these swing highs is because people who are already short would have their stop losses at this swing high or this one. Kind of using that, we're going to have our limit orders, our entries here at their stop losses. Now our stop loss is going to be here, and it's going to be above this 5-minute gap. It's going to be above this 15-minute gap, as well as this 15-minute order block on the minute chart. And essentially, if these do not get respected, the gap, the order block does not get respected, then our stop is fine, right? It's probably not one of those quote unquote reset moments, and we might actually just be going higher, and that's fine. Our bias would just be wrong, and that would be a losing trade. Okay, so with that in mind and the trade setup, the limit order would be here. We can sit back, relax, go get some breakfast, and come back when 930 comes. Okay, so 9:30. Exactly at 9:30, we have equity open, which comes up and boom, hits all of their stop losses, people who had stop losses here. And what that meant was our limit order was also filled. So we would have been short here and we would have gotten filled, which is very nice. Now once we're in a filled position, we can kind of look at targets, which has already been outlined. And back on a 15-minute chart, we can see here. Targets would be here, here, here. Now, while we're in a trade and we're trading this live, we're unsure of how deep it's going to go. We could have the overall target all the way down here, but it is important to take partials at these levels, right? Because it might not hit the best level. This is the best case. This is the best case, and it might not always be best case. So we could take maybe 20% off here, 20% off here, 20% off here, and then a 40 at the overall best case scenario targets. So with that being said, let's see what price does. And at this point, you'd probably want to wait until 10 o'clock just in case if there's any more retracements before rolling your stop to break even. Right now, even though you are in a slight profit, I would keep stop at the original price for stop loss. Okay, 10 o'clock rolls around and notice how very close to 10 we start rolling down. 9:58 was the last green candle. And that's just to emphasize the importance of time, right? 10 o'clock represents 30 minutes after equity, where manipulation usually occurs. So now we move stop to break even. Price has hit our first target, so we take 20% off and we just let price play. We can go get some food and we don't really need to be looking at charts anymore. Now after trading for around 2 hours, we see that price does in fact retrace a little bit, but then overall it goes down and hits our targets. However, price was very close to hitting our break-even point, and honestly, that is fine, right? There's just a lot of retracement, and there could be a situation where your break-even or your entry might not have been that high, and you would have gone stopped out. If that does happen to you, right, it's really important to note that really don't let it affect your mental. The trade idea was right, and your mindset behind the idea was right, and that's what matters, right? Just to be able to identify and use liquidity to find and see where the market is going to go. In this case, since our entry was at the wicks of these candles, the wicks of these swing highs, we were safe and we did not get stopped out. Overall, this trade would have been a 1 to 5.5-ish, and I hope you guys found this insightful.